All right, so I hope everybody's having an enjoyable Memorial Day weekend, remembering those who have served our country in the ultimate way, given their sacrifice, their life as a sacrifice. So we appreciate especially our loved ones who have done that, and I think it's a good day to remember all of our loved ones who have passed on, and remember their impact on our lives. So I hope you all have had an enjoyable weekend. The debt ceiling got passed. So it seems like the market kind of ran up into the end of the week, maybe anticipating passage of the debt ceiling resolution. It didn't get passed, but it looks like a deal has been made over the weekend, and now the question is whether it will get passed. But so far, markets are liking this in the after hours, the extended market trading here, the futures market. So we'll see how that carries in. I'm going to talk about in today's video this dramatic divergence between literally a handful of companies and just about everybody else. So we're going to talk about this idea that a handful of stocks are leading the markets, whereas some people are saying that's not the case. So we're going to take a look at the technical aspects there, big moves in some different assets beyond the stock market that are impacting kind of what our expectations, and some big technical signals on the NASDAQ 100 itself. We'll take a look at what those mean, and then break down with our trade idea of the day of a stock that's not in those main three sectors, and talk about how to trade a stock that's not doing as well, and we'll see how to go from there. So let's go ahead and get started. Today is Friday, May the 26th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. Okay, before we get started, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment down there on anything that stood out to you today in today's video. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab, hit that like button. Same thing here, click the thumbs up icon. It opens up a new tab, hit that like button there as well. Again, the goal as always, every time we mention it, is to try to get to 100 likes on Twitter. So kind of a reflection of kind of what we need to get our content out to all of our followers. So we really appreciate all of you who do like these videos day in and day out. That help us get us there most days. For those who don't, you can click on that right now with one or two really easy clicks while you're watching. All right, let's start off taking a look at the S&P 500 with the market forecast indicator, as we always do. Highest close to finish the week that we've had since August, right? We're at 42.05 there, here at 41.99. So all the way the highest close since August expiration of last year. So it's been, about going on 10 months now that we've made this kind of round trip from to create the October lows. And then now basically the bullish trend that we've been on since then. Multiple intermediate rallies, a couple intermediate declines in the middle that were very weak. And then now you can see the intermediate line is still slightly below market sentiment, but it is at least rising. It's nearly at its 70th percentile. The momentum line also nearly at its 70th percentile. So you have almost all four lines at the 70th percentile or higher. Of course, getting over the 80th percentiles when you get the cluster, the red dot that we saw back here, in December. We are a little bit more than 1.5% above the moving average, so not significant there. We are back up above that black line there. So when you look at, when you look at this close where we're at, we had dipped back below these significant yellow and green lines before the last 2 days. Very similar. The last couple of times we've gotten these bull tags. This one is official. This one kind of not necessarily official because we weren't quite below the 80th percentile. And over here we didn't have a yellow line because the moving average was falling. So really we've had four bull tag patterns. Only two of them actual bull tags. And then you can see the rally off every one of them. Boom, 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 and now this one. Last two getting up above, at least on an intraday basis, this black line. But all three of them, three of the four, this one not included, but three of the four got us above the yellow and green lines. Remember, this is the 78% retracement of the intermediate decline we've been retracing now for like months. The orange line, is the 50% retracement of the entire correction that we've been on right now. And of course, the black line is a 23% retracement of the post-COVID rally. So getting above this 23% line basically ends the move to the downside now, right? It ends this correction that we've been on. And again, it doesn't take one day, because in August we got above it, and then that was a fantastic break, a fake out pattern that ultimately led to this intermediate decline that we've been retracing now for multiple months. But regardless, pretty good move there. Let's look at the NASDAQ 100, which has been the big driver of this, really going parabolic there. Now it's at its 23% retracement of its post-COVID rally. So if I were to go out a few years, you can see there's the rally, the end of the rally at least. There's the correction down to the 62% retracement, which the S&P did not get down to. And then now you can see we've caught up to, so now it's pretty much caught up to where the S&P is. Remember, the S&P did not get down to that 62%. That would be way down here at the end of the year. In fact, it was sitting at the 38% retracement. And now it's at the 23. So the NASDAQ at the end of the year was pretty much on, or really close to the 62% retracement of the post-COVID rally. And this rally has basically been a catch-up trade, has gotten all the way back up to it. Looking at the Dow Jones Industrial, and you can see we almost got the cluster there, only missing the momentum line. The Dow, on the other hand, is coming off an oversold cluster, so dramatically different. Remember, it already is above its 23% retracement. It got above it at the end of last year. Did not even come close. Remember, at the end of the year, the NASDAQ was sitting down here at the 62% retracement. The Dow was already above the 23. So the Dow, the S&P and the NASDAQ is caught up to where the Dow has been now for months, being up above there is one reason why your Dow is kind of losing steam. And then, of course, your Russell 2000, if we bring up the drawings on the Russell, the Fibonacci lines, there's your 23% retracement. This is where everything else is. The Dow's a little bit above it. The other two are sitting here, and your Russell is nowhere near that. Your Russell is way down here, nowhere near its 78% retracement of that same intermediate decline, which is up here. Nowhere near the 50% retracement of this current correction, which is up here, and then nowhere near that 23% line. So the Russell continues to be the tremendous laggard, not able to really get going at all, even though the NASDAQ 100 is just blowing it away to the upside. You did finish strong, though not necessarily back up above that 38% retracement, which is, again, acting as resistance in your intermediate line, not producing a peak there. Your Dow Jones, remember, the intermediate line is actually still in the reversal zone, much less up here in the upper. It's way down here. And your short-term sentiment is not that bullish yet, at least, right? It might get more bullish, but not quite. All right, now let's take a look at the weekly market forecast, since it is the end of the week. And we can see here the long lower shadow that we're getting so far, or that we got this week. Not nearly as bullish, or as bearish, as long upper shadows are, like this one, or even this one here. So not nearly as bearish as long upper shadows, but they are bearish to get long lower shadows. That means the bulls are around, right? They've been around. They just didn't finish the week. The bulls finished the week on the high note. And that's what brought your near-term line still into bullish territory, and your momentum line trying to get going again back to the upside after getting this cluster just a while ago. Of course, your NASDAQ 100 looks dramatically different. It's just progressing to much, much stronger highs. 16.5% above its 30-week moving average. The S&P is only 4.5%. Your Dow Jones Industrial Average is actually below its 30-week moving average and getting a bull tag. So remember, bull tags are either tremendous bounce signals, like this one over here when you're in bullish trends, which you can argue we're in right now, since we've been dark green shading a green line for a while, or they start new corrections. They start the corrections because we're on a weekly chart, so they would start corrections. And so that's, we got a bull tag this week on the Dow Jones Industrial Average, and like I said, we're 1% below the 30-week moving average. The Russell's also below, almost 3% below the 30-week moving average, and you actually have a bearish intermediate posture and a red line now. So again, dramatically different postures, even on the weekly charts of what we're seeing. Though the S&P is showing a little tiny sign of weakness with that long lower shadow again, while the NASDAQ 100 is just blowing everything away with its relative strength. From a 3 green arrow standpoint, we do have 3 green arrows on the S&P and the NASDAQ. The NASDAQ's had 3 green arrows this whole time. The S&P's had 3 red arrows here recently. The Dow is continuing to have 3 red arrows, so it's multiple days now. And then your Russell 2000 has been fluctuating. It still has one red arrow on the stochastics that keeps it from turning to green. Looking at the 2-line version of this chart, again, you can see the breakup, above the 8-day moving average, everything looking great there. Not the case in the diamonds. The diamonds did bounce, but basically right to the 8-day moving average, right to that 78% retracement. Still below the 17. MACD is still negative, still below its moving average. The 8 and 17 both falling below the 30. So we're still very top heavy on the Dow, still showing a bearish pattern there. Same thing with your Russell. We did close above all 4 lines here, with all 4 lines traversing through the range of the day, though the MACD and stochastics more neutral than anything, not necessarily bullish or bearish, and you've got a very strong support with the point of control now below us on the Russell 2000. Let's take a look at some of the other oscillators for the S&P. Big bounce back on the positive indicator back up here. Your NASDAQ is just unbelievable. I mean, it's gotten above almost a 45. Again, that's about as high as we got over here. When I cut this in half, when I cut the DMI in half to kind of get an idea of the short-term nature of this, we're up to 56. We're actually higher than we were there. So, I mean, a very, very parabolic peak on the NASDAQ 100 that it's hard to follow through with. That's why it's going to be hard to have a very strong week this week in these kinds of stocks, considering just how strong that indicator already is. And again, the ADX is here at 30. It's very lagging, so it usually peaks well after the D. So here the DMI, the directional indicators peaked, at least the negative peaked, and the ADX peaked well after. Over here, the positive indicator peaked, and then the ADX peaked after. So I would expect to probably get up closer into the 30s, if not closer to 35, considering how high this indicator got. And remember, the difference, the other side of the equation is your Dow Jones, which still shows a pretty bearish DMI pattern. The positive indicator did bounce, so it's still below 20, and the negative indicator dropped, though it's still easily above 25. So pretty distinct patterns there. Looking at the RSI and the CCI, you can see the S&P is relatively bullish, not strongly bullish. We're not above 60. We're not above this 150 mark, but relatively strong nonetheless. The NASDAQ 100, of course, is highest RSI that we've had, higher just barely. If you look at the RSI at 74.18, over here is at 73.5. So just barely higher than what we saw there. There was this thought over the weekend, and I tweeted this out, so let me bring this over here, about the NASDAQ 100, and you can see those highs there, and how it did relative to the equal weighted NASDAQ 100. Because the idea is, a lot of people have been trying to point out over the weekend that this is not just 5 companies. That the NASDAQ, if you look at the correlation between the NASDAQ 100 and then the equal weighted NASDAQ 100, there's not very many times it's not above 90%, much less, above 80, or, you actually got below 70% multiple times in the past 5 years. Both of these other 2 times preceded these corrections, the last two of the last 3 corrections, COVID right before that there. But if you look at the chart here, the NASDAQ 100 in purple is well up above its February 2nd exhaustion peak, way up above that, and easily above its August peak. The NASDAQ, equal weighted NASDAQ 100 is not. So it barely got above its February peak, though remember the NASDAQ 100 blew it away, and it's actually not above its August peak, though the NASDAQ 100 is. It is like, when you look at these companies, this was another chart that came out. It's like, oh, we had 90 stocks in the month of May reached 52-week highs. Well, when you break that number, that list down, 5 of those 90 are the mega caps. You don't have the you don't have Amazon or Tesla from consumer discretionary. So you don't have all the Magnificent Seven, but you have 5 of them. Well, those 5 stocks, which are 1% of the S&P, make up 22% of the S&P 500 on the cap weighted basis. So almost a quarter. Those 5 stocks by themselves. The other 85, which are 17% of 500 stocks, make up this percent. I mean, so that's pretty normal. Like those 85 stocks make up the typical makeup of the S&P. Obviously, 1%, 22% of the S&P coming from 1% of the stocks is not normal. So this is still a move largely driven by literally a handful of companies. As you can see, I pointed out here the sectors, and we'll come back to this later, not looking too bullish across 8 of the 11 sectors, and really only getting strong 3-month returns on 2 of the other 3. Remember, the discretionary Amazon and Tesla is not producing new 52-week highs this week. So I mean, yes, the NASDAQ 100 is just blowing things away right now. Very parabolic across all sorts of indicators here. Looking at the Ichimoku cloud, you can see there's no trend on the S&P. There's no trend on the diamonds or on the Russell 2000, though the Qs have a close to a mature trend, which is just again uncommon. You can see how strong that rate of change is. When I look at the rate of change over the past, I think I've saved this for 26 days. Yeah, so here's 26 days. You can see it's up 10%, the rate of change for the NASDAQ over the last 26 days. The S&P is less than 2. Your Dow Jones Industrial Average over the last 26 days is -2. Your Russell 2000 is -1. So dramatic difference there again. And again, remember the Magnificent Seven make up 53% of the NASDAQ 100. So when you look at the NASDAQ 100, you're basically looking at one indicator. Let's look at some of the other oscillators here. We'll look at the Bollinger Bands and the Keltner channels. So the Qs, they started this whole thing back on March 16th, and we talked about this quite a bit in our technical analysis class on Friday. But it started this whole thing with a good, strong rally, 2% plus gain, got above the Bollinger Bands, did not get above the Keltner channel right there, did not get above the Keltner channel, but got above the band, and we started our new trend to the upside. Well, now we've been on this trend for a while, and you're still breaking out upside the band, way outside the Keltner channel. So it's not common to get this far outside the Keltner channel. You can see you can kind of get a little bit above it and keep kind of grinding up here, but this is a dramatic move above. The Keltner channel is at $339. This is at $348. Again, if you look at the opposite, your diamonds, which has been in the lowest quartile for the most of the week, bouncing back up here today, still in the lower half, but you can kind of see it's flirting with the bands getting outside the Keltner channels on a bearish move. So it is pretty much. Remember that those Magnificent Seven only make up 9.5% of the Dow. They make up over 25% of the S&P. Again, 53% of the NASDAQ 100. 9.5% of the Dow, because only 2 of them are in the Dow, and this is price weighted average, not a market cap weighted index. So not having the same impact. Here's your where you are in the 4-week range. Your S&P and your NASDAQ are just blowing that 4-week range away. Your Dow Jones, on the other hand, still below the average down there, and your Russell 2000 is trying to get above it. Got dropped back below it yesterday, bouncing back up above it here today. When we look at that intraday range here, here's the new 4-week high point. So the Arun indicator's got you're right back up to green 100 there. Still not really expanding the bandwidth. The bandwidth is still really small, but at least we're pushing up to new highs. That's not the case for your diamonds, which actually got a new 4-week low point here recently. And then here's your Qs, right? Your Qs do have a pretty significantly large 4-week range. It's been getting bigger now, but really, I mean, look at that move. You got that gap over here on Thursday. Not a breakaway gap, not really a runaway gap either, because we weren't coming off of an intermediate low point there. So you would consider that, as big as a gap as that was, because that was a pretty decent size gap on the Qs, leading to two consecutive days of 2% rally, which we haven't had since going back to February. That February 2nd peak was the last time we had a two consecutive day. There's your March 16th that started, or that's April. Back here is March 16th. That started this whole thing. We never did get the 2% gain on the S&P, right? But February 2nd was the last time. We also had a pretty, 2 standard deviation opening gap there, just like we did here. The expectation is that you'll probably fill in that gap sooner rather than later on the NASDAQ. And again, that's not going to be too kind to the markets, because that's pretty significantly lower. I mean, you fill in that gap, you're going to be in the lower half of the range, of the 4-week range. We've moved up so far in the last couple of days. Even with this debt ceiling, you wonder if the markets will, if this was kind of a buy the rumor into that debt ceiling announcement, only to come back in and sell the news and fill that gap in, like I said, would not be the best sign for the markets. Let's take a look at the range today and the volume. You can see both above average, so 5.5 points, not including the gap. Of course, your Qs blew things away. Your gap was, your range was 8.5 points, well above the average of 4.5. Volume wasn't too strong when you put those numbers into context here. So the S&P at 5.5 points is not too strong, but it's above the average. And as I said, the volume was above the average too. The Qs, the average, your average range, 8.5 points, is way up here. It's a big number. That's not the typical number. Again, that's kind of what we saw over here when you had these two big ranges in February. Here, this was a 11-point range when the average was 6 points, and then you had this 7-point range, or 6.95, and the average was 6.72, and that doesn't include the gap of a few points. So those are really big ranges. The last 2 days that we had two consecutive 2% gain plus days, we've just had it again. You wonder, again, going into resistance no less as well, 62% retracement of the correction. You wonder if this is it for the NASDAQ, considering how parabolic it's been to get to this point. Let's look at the VIX. Of course, the VIX has been kind of its own fascinating story. The VIX is down well below 20, back below 90% after getting above both those marks earlier in the week. You can see that the correlation with the VVIX has moved back up. You can see where we dropped back down to below 18. The VVIX barely below 100, so it's still very, very high relative to where the VIX is. And so if I were to throw on the comparison, you can see it together. Again, that's our problem here, is we're not getting, we're still way up above these highs, these lows, way up. I mean, the VIX is actually below its March lows. The VVIX is way up above those March lows. So, this is quite the move that we're getting here, and it's not necessarily the best move that we want to see for this discrepancy. Again, it usually leads to the VIX catching up to where the VVIX is. All right, now let's take a look at what's driving this price action this week. And you can see, I mean, it's pretty much QQQ. That's the main driver this week. And really, it's the last 2 days, because it was down going into Thursday morning and then gapped up. And you can see finished the week up 3.5% after being down at one point right around 2% on the week. So nice, strong rally. The dollar was progressively higher throughout the entire week, has been progressively moving higher. Bond yields were doing pretty well until they dropped here. Bond prices rallied here by the end. But everything else kind of flat to down. Gold was down to strengthen the dollar. Real estate's down. That's been considered a risk appetite trade here lately. And of course, developed markets are down. We'll take a look at that here in just a second. But let's take a look at some of these other asset classes on their charts. The dollar first. Like I said, the dollar's been on a nice good tear. Obviously breaking through its 50-day moving average, filling in the gap between the 50 and the 200-day moving average. Breaking above the 30-week moving average with the MACD and stochastics that are rising. So pretty good change in direction that we haven't seen on the dollar for quite some time. The 10-year yield also broke above its 30-week moving average. I actually did that last week. Followed through on that this week with a strong move above 3.8%. I don't think it's open yet here, the bond market. It's Monday afternoon. It's still at 3.81. So we'll see what the impact of the debt ceiling resolution will have on that, on the 10-year yield. But that's a pretty good run. I mean, that's on the weekly chart, of course. You can see the MACD is turning positive. Stochastics still in bearish territory, but rising. And you can see on the daily chart, very strong move here, well above the 200-day moving average. And again, it hasn't been bullish for bond yields to be this strong. It's generally been a sign of rising inflation expectations when you're looking at that 10-year yield. If you look at the yield spreads between the 10 and the 2-year, they're back down to some relatively, not the lowest, they're not down to 100 basis points that they were right before the financial issues gave way, the regional banks, but they are to their lowest level that we've seen in a while. The close here was at minus 66, so we're at minus 76 right now. So the inverted yield curve is getting lower. We are at 151 basis points here, which is actually gaining ground. Again, you can see earlier in the month was at 192 basis points. So again, but even at 150 is the lowest level it's ever been. At least on the records that they have. So the 10-year yield is rising, and again, we do not want we want the yield curve to stay inverted as long as we possibly can have. I know it's not. You can see it's temporary for it to be this low. It generally rises, but every time it rises like this, it's bearish, right? So we don't want it to rise. We want it to stay if we're going to be bullish. If you're going to get to all-time highs, we want it to stay down as long as possible. There's two ways it goes up. The 10-year yield takes off well above 4%, which obviously we've seen is not bullish for equities. And the other thing, because it means that inflation is rising back up again. And the other issue is that the Fed starts cutting rates. And the Fed's cutting rates, again, without it leading also to rising inflation, because cutting rates generally in the past, when you cut the overnight interest rate, inflation rises. So they don't want to do that, right? They don't want inflation to rise again. So they don't want to cut rates too early. They want to wait until they absolutely have to. So if the Fed is cutting rates and the yield curve is uninverting, then that means they absolutely have to, which means we're in for it from that perspective. So if we're going to be bullish, we want to stay with the inverted yield curve as long as possible, right? Stay right around this 3.5–4% mark in the 10-year yield, and this goes sideways with the overnight rate getting, as of right now, looking like there's a high probability that we're going to get to 5.5%, especially now with this debt ceiling resolved. You'll probably see the odds of this. It was up to 64% at the end of last week, and it has been easily above. You can see it has been above 60% easily. It has been above 80% for more than a week. So it's very good chance that this could get back to 100 or get to 100 like every other line has gotten to that's been above 60%. But then that's it. If you look at, again, the July figure, the 5.75% line was rarely above 60 or even above 80, just for a couple of days for both. So very unlikely that we'll get to 5.75%. So more than likely going to stop at 5.5% in June. That gets us, by July's CPI release, that will most likely get your real CPI number to 2.5%, right? That will get this the 2.5% mark, because again, the year-over-year CPI is more than likely going to drop to about 3%. Let's see what the right here the inflation nowcast is for May. So this will be released in June. You can see it's supposed to drop to 4.12 Right now, you're sitting at a year-over-year rate of 5%. So you're going to have a pretty significant drop. That's for May, and you can see the June figure, the June month-over-month figure last year was actually bigger than the May figure was. So when you look at it here, so here's the May figure that's was at 0.92%. The June figure was 1.18. So when you look at that, that means we'll probably, I would expect, will be a lot closer to 3% with the overnight Fed funds rate for June. So when the June comes on here, so when the overnight Fed funds rate comes out at 5.5, then that will give us a 2.5%, which is, like I said, I think that's been the Fed's target, is to get it to 2.5% like it did in 06 when they stopped raising rates in 06. They got it to 2.5% for about a year. They got it to 2.5% since at the end of 1994, and then kept it there for 6 years before they started to cut rates. They had a brief little mid-cycle adjustment in the 90s, late 90s there, but they kept the real Fed funds rate at 2.5% that entire time. After that strong rate hike cycle in 1994 that a lot of people are comparing this rate hike cycle to. So again, that's kind of what we want. We want it to get there. We want things to stay there. We want the inverted yield curve to stay. We want things to, we don't want inflation to rear its ugly head again, because if it does, and when it does, it generally leads to, here, let's go to the year over year. It generally leads to higher rates than what we saw on the first peak, as you saw multiple times over here, and then even here in 06 and then 08. When the Fed starts cutting rates, inflation will rise again. So I think what they want to do is wait, just like here in the 50s, wait for it to come all the way back down, to practically nothing before they start, cutting rates, and we're in a recession at that. This is similar to what they did back then. I did want to show the global 12 grid and then the sector 12 grid. So let's look at the global 12 grid here. So we saw that the developed markets didn't have that great of a week. Well, look at Germany, Italy, France, UK, and Canada all have dark pink shading and a red line. In addition to China, the biggest emerging market out there. Now, India is doing well, up 7%. Korea is doing well. So not all emerging markets are struggling, but China is. And then, of course, Brazil, another emerging market, is not doing so bad. Japan is the one developed market that's also not doing so bad. So not everything is bad, but your developed markets, which have been so bullish, got the clusters. They've been so bullish, not bullish at all right now, all showing bearish market forecast patterns. When we look at the the sector performance over this past week, let's go to just this past week here. There we go. When we look at that performance, again, it's all this QQQ names. They're the only ones that were higher this week. Everything else was down, some down 2 to 3% for the week. So when they say that, it's not just 5 companies or 7 companies going up, it pretty much is, right? Because everything else is showing a bearish market forecast right now. Dark pink shading, a red line. You have multiple clusters. On Wednesday, I believe we had 92 clusters, oversold clusters in the S&P 500. And then you have 3 sectors that are showing bullish patterns, and 2 of them are in double-digit returns for 3 months. 20% on XLK, which is NVIDIA, pretty much, but also Apple and Microsoft, and then 16% here from XLC, which is pretty much Facebook and Google, making up that sector, and as well as Netflix and Disney, a couple other major companies in that sector. And then, of course, XLY is 3-month highs, but very much smaller range, as it's only up 4.5%. So everything else has bearish market forecast patterns and negative 3-month returns. Really only staples at 2% 3-month return, and healthcare, which is 0.25%, are positive. Everything else are all negative numbers over the past 3 months. So it is literally just a handful of companies, because these 3 companies are just dominated by those mega cap. These 3 sectors are dominated by those mega cap names. When you look at XLK, Microsoft over here, Microsoft, Apple, Nvidia make up, it looks like about 50% of that of XLK, 24, 22, 5. So 46, yeah, about 50, a little bit more than 50%. Those three companies make up 50% of XLK. You do the same thing for XLY. Whoops, not XL7. XLY, those two companies, Amazon and Tesla, make up 40% of XLY. And then finally XLC, it looks like you have 40% between Meta and, no, see, 51% between Meta and Google, and 51% between Meta and Google. And then you add on like Netflix, which is another 5%, and Disney is another 3.5%. So, I mean, those three sectors are dominated by those seven, the Magnificent Seven, and the Nasdaq 100, like I said, is over 53% from the Magnificent Seven. So this is the rest of the market that you see down here. So it's hardly only, you know, that this is raising everything else up with it. You know, I mean, yes, everything was up on Friday, but they were up off of lows on Friday and still showing bearish patterns across the board here. I wanted to take a look at a couple other charts really quickly here before we go into our sector performance. You can see the Qs closing relative to IWM, closing up here at nearly 1.98. If you go to the weekly chart, let's go to the weekly chart there. 1.98, the highest, by far the highest weekly close on this in a very, very long time. You have to go all the way back, well more than 10 years. You have to go back to the 2000s to see the range be this high. There we go. So way back over here in 2000, 2001 is the last time, the end of 2000 is the last time we've been near at 1.98. This is well up above the point. You can see the weekly RSI is up near 80 on the relative strength. You can see the parabolic move that this has really gone on just in the last so many weeks, much less the last 21 weeks. As I mentioned, the return on the Nasdaq is very strong year to date. You can see the CCI is high. You know, the MACD is really high, nearly at 5. Again, it's only been higher than that in 2020, coming out of COVID. So extreme moves to the upside. Then when you look at copper relative to gold, you can see that's how you would think, okay, well, if this is a risk-on move, that this should be also moving higher to strong highs that we haven't seen since 2000 or whatever, and it's, you know, actually on a decline, on a significant downtrend. The PPO dropping here, the long-term PPO dropping below 0. You can see the CCI is down here at 0. The RSI is in bearish territory. So this is hardly a risk-on move to see this ratio in a downward trend below its 200-week moving average, no less. All right, so before I traded the other day, I wanted to take a look at one of the stocks that's not in those three power sectors, and that's Morgan Stanley here in the financial sector. It has been relatively bearish. Dark pink shading, a red line on the bearish intermediate decline. The market sentiment line is falling into, or close into, the reversal zone here, with a small little bounce in short-term sentiment after getting a cluster on Monday. So we've been pretty bearish, and it appears to be kind of slowing its descent. You did ended up with a slightly higher close and a little bit of an upper shadow here. So, you know, somewhat of a transition candle going there on its weekly chart. And then you look at the three green arrows, you can see again we've been in this convergence mode with the MACD above its moving average, but the price still well below its 17-day, but not until Friday. So Friday we did close above the 17-day. MACD is rising, stochastics is rising. So the downward move that we've had appears to be ending that move. The DMI, you know, again, we're not quite below 25, but really close. I've been flirting with that line for most of the day on Friday there. The RSI and the CCI also into neutral territory on both of them, out of bearish territory from where they were. And then look at the Bollinger Bands here. And you can see again, had been in the lower quartile, but now the bandwidth is dropping sharply as we're into the middle of the chart. And now we have the bands inside of the Keltner channel. So we got we have bearish momentum, but now we have a red dot. So one other chart that we didn't show is the Ichimoku cloud. You were above the green line, still a pretty deep rate of change there, negative rate of change. But again, the trend is very weak. Whatever bearish trend we had, which wasn't very strong to begin with, is really, really weak here. So what has been bearish appears to be kind of weakening alongside of this kind of volume node point of control, moving back up inside of the value area, moving back up towards the point of control. So what we decided to do here was to do a iron condor spread, selling the low 20 deltas on both sides, buying 2 strikes away on both sides for protection. You ended up getting, let's see, what did we end up getting on the trade? For the $1,000 of risk, getting about $400 of reward. So pretty decent credit for that. And you can see the break evens here. You know, if we're going to be breaking down, you're going to be breaking down into, you know, out of the value area. So you're going to have a directional move to the downside there. If you break up above the upper break even, you're going to be breaking above the 200-day moving average and working your way in that direction, which would be a pretty decent directional move there. So getting outside of either one of these would require a pretty decent directional move. So a good opportunity to try to take advantage if we kind of stay in the middle with a declining Bollinger Band with there and in a kind of a tightening range. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. Takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Like and follow us on Twitter and Facebook as well. Have a great rest of your Memorial Day weekend, everybody. And we'll see you all on Tuesday.